Hello and welcome to Sectors Up Close. I'm Oliver Regan. Our focus today is on US Real Estate Investment Trusts, or REITs. And my guest is David Sekera, Chief US Market Strategist at Morningstar. The prospect of higher inflation and interest rates has hit REITs hard. According to this metric, the MSCI US Real Estate Investment Trust Index, the market is down about 15% in the year to Wednesday. That's slightly worse than the S&P 500. Other similar indices have performed about the same. These are companies that appeal to retail investors because they offer stable income based on the rents they earn and because they are backed up by the value of the properties they hold. This group includes warehouse owners such as Prologis and public storage communications infrastructure companies such as American Tower and Crown Castle, while other REITs invest in everything from apartments to shopping centres to hotels. So how should an investor approach this sector? Let's ask Morningstar's David Sekera. Well, David, what's your view on valuations given the recent sell-off?
Well, the broad REIT sector coming into 2022, according to our calculations, was actually the most overvalued sector, coming into the year. And as you mentioned, it has underperformed, the rest of the market. But even with that underperformance, it does remain to be the second most overvalued sector under our coverage. Now, having said all that, of course, there are a number of stocks that have fallen enough, that we do think they're attractive foreign investors, and a number that we now rate, 4 out of 5 stars.
So what will be the impact on inflation on this market, and does that create any opportunities?
It does. So specifically real estate, over the long term is typically a pretty good inflation hedge for those investors that are concerned if inflation, remains higher for longer. But I would note that in the short term, I would really look for those REITs whose underlying assets have short-term lease structures. So that way, as those rents are increases as those leases expire, those REITs will be able to keep up their dividend payments. So 2 categories specifically that I'd invest in would be looking at the apartment REITs and the single-family home REITs. Now, on the single-family side, one that we think is slightly undervalued today would be Invitation Homes. And then looking at the apartment REITs, one I would highlight there would be Avalon Bay. Another area that investors could look at is in the senior housing sector. So according to our valuations there, most of them are pretty fairly valued, but I'd noticed that 35 to 40% of the leases there, those also are short-term in nature, so they'll be able to keep up with inflation. And we also think there's a good tailwind from demographics for the senior housing area. Just as when we look at the population aging, we do see an increase in the 80 and over population demographic group, which provides a good tailwind for that sector. One name that I would look for in that sector would be Ventas, which is one of our best ideas right now.
In your notes, you talk about the impact in changes to consumer behaviour. Can you explain?
Mm-hmm. Sure. So one of the main investment themes that we've been looking at for 2022 is kind of the economic normalization and specifically consumer normalization. So as the pandemic recedes, as we head into spring and into summer, we expect consumers to kind of go back to some of their old habits and start to see a shift in spending, away from the goods that we've seen for the past 2 years and back towards services. So for example, one of those areas that we are looking at would be the travel sector. And specifically for REIT investors, we look at the hotel space. So again, hotels will be able to benefit as we have increasing occupancy levels. And also from an inflation point of view, the hotels, of course, have the shortest duration because they can reset their room rates every single day. So one area that we would look there, or one name specifically that we think is undervalued, trading at about a 20% discount to our fair value, is Park Hotels.
Anything in this sector that investors should stay clear of?
The ones I would steer clear of today are those that have long-term contracts in place. So for investors that are concerned about inflation, those long-term contracts, especially the contracts that don't have, inflation escalators or capped inflation escalators, would be the ones that I think would underperform, until those contracts come due, which in some cases might not be for, 5 or 10 years on those leases. So the ones there that I'd point to would be the triple net lease companies. For example, Realty Income would be one I would shy away from. But then also, as you mentioned earlier, the cell tower companies, those are ones that we think are anywhere from 20 to 40% overvalued. Looking at like SBA Communications, American Tower, Crown Castle, we think that the market is over extrapolating kind of their growth expectations for the amount of spending on 5G. Plus, the investors are just paying very high valuations because those are considered to be, safer than other types of REITs. They do have very steady cash flow streams. They have low counterparty risk, with counterparties like Verizon and AT&T. But however, I think that, that lower rate of return is lower than what we think is justified for those types of risks.
David Sekera, Chief US Market Strategist at Morningstar, thank you very much. Before I go, here are some of the top stories in this space. New US home sales came in lower than expected in January at an annualised 801,000, down from a 9-month high reached in December. The new housing market is being underpinned by record low inventory of previously owned homes. Demand for housing is expected to remain strong even as mortgage rates increase, which together with higher prices will erode affordability. Official data out earlier in the week showed US house prices rose 17.6% in December over the year before. American Tower reported mixed results for the fourth quarter. Revenue rose 15.2% to $2.44 billion, which is slightly better than forecasts. But the owner of communications infrastructure in 25 countries said adjusted funds from operations missed at $2.10 per share. Its shares are down 22% in the year to Wednesday. Shares in the Chinese developer Shimao plunged after a trustee said roughly $170 million worth of asset-backed notes may not be redeemed at maturity. Investor confidence was also hit by a fresh downgrade of its rating by Moody's, highlighting the debt crisis affecting China's bloated developers. China last year stepped up efforts to deleverage the sector, driving the industry into a liquidity crisis that led to high-profile defaults by China Evergrande and smaller rivals. And that is your roundup of the US real estate sector. I'm Oliver Regan, and this is Reuters.